scaling truly is a game of one, removing constraints, but two, placing risk-adjusted bets. The elite, they don't place bets that have binary outcomes and potentially bet the farm or bet the whole business's existence. They place bets with limited downside. All right, we're back. Episode 16. Dylan, what's cracking?
I'm excited to chat about product launch strategies. I've seen like a lot of different approaches to this. I think you were talking before this about how like whether you're an LTV dominant brand or a one-time purchase dominant brand can like have huge implications for what might be best. So looking forward to chatting about it.
Yeah, me too, man. It's interesting because I've been talking a lot with my team and in my content about this concept of placing risk-adjusted bets, because the more brands that I work with and the more that I have conversations with my team about how we can be better CFOs, the more that I realize that scaling truly is a game of one, removing constraints, but two, placing risk-adjusted bets, right? And what separates the elite from the mediocre is the elite, they don't place bets that have binary outcomes and potentially bet the farm or bet the whole business's existence, right? They place bets with limited downside, which is what we call risk adjusted. And the reason I'm saying that is because in talking about scaling product launches, or like planning and scaling product launches over time, what strategies to use, I'm trying to coach brands to reframe product launches as risk-adjusted bets, because that's really what they are. They're allocations of capital, right, to an investment, in this case, a new product launch that you think that has a specific risk profile and a specific potential return profile. And so I'm excited to talk more about this because I think a lot of brands just get excited about bringing new products to market because founders tend to be product people. They love their products, right? They love what they bring to the market. But I'm excited today to talk about, in addition to the wisdom you can bring to the table, like how to reframe these as risk-adjusted bets.
So as you're talking, I'm thinking like, are you about to come out with the ultimate DTC product launch Sharpe ratio calculator? That could be the next big lead magnet.
Yeah. Don't tempt me, Dylan. So, what I was just going to ask you is like, obviously you being in the agency world, product launches certainly come across your desk all the time.
Yeah.
When a brand comes to you and starts talking about product launch, just walk me through the first several kind of conceptual framework, areas that you're like, hold on, we need to break this down and talk strategically here.
Yeah. So I'll kind of take this two paths. So one is, hey, we are launching this product. Like, it's not a question of if or how much, we're just launching this product. My first question is, well, how much do you have? Is it going to be a product launch that needs paid support, or is it going to be like retention only? Because I think that when you develop products, you should develop them with a preconceived idea of if you want it to be a ad-based product or a retention-based product. Sometimes you'll guess it's one and it's actually the other, but oftentimes you can have a gut feeling and do a fairly good job of understanding if it's going to be one of the two. And in the event that you don't have enough enough units, to do paid, and you think you can sell it through email and SMS, generally, by all means, just do that so you can get more profit per order most of the time. Sometimes brands will be like, yeah, we actually don't have that much, but we're going to purposefully use it on paid because we want to validate it as a paid product or not. But if the intention is not, let's validate it, it's just like, let's get the best return on these units. Generally, we'd go email SMS first. And then if we have to deploy paid to move through the final units, ideally assuming that the acquisition metrics or the cost per purchase or whatever actually makes sense. So that's kind of the first thing. The second thing is like, okay, what if I'm thinking about launching this product? I think that gets into a conversation about what's the intention behind it. Is it going to be more of an acquisition SKU? Is it going to be more of a retention SKU? And how likely are we to actually move it? Is it a whole new category? Is it a variant of something that's already a top seller that like you're pretty confident is gonna move quite well? And then the conversation would kind of go from there.
Okay, so Man, a lot of things I want to ask you about. Where do we dive into first? Well, I guess I'll follow the recency bias in my brain and talk about the thing that you said last, which was you talk about acquisition SKU versus retention SKU. What point, this is kind of like, I'm going through this with a brand I'm working with, which is why I'm so curious. Like, I think this particular brand is struggling with thinking that all their SKUs are acquisition SKUs, when in reality, I think this brand is known for one thing in particular, right? Mm-hmm. And their CMO has been trying to tell this narrative, I think in large part correctly. Like, listen, we are known for this. This is our flagship product. This is our acquisition SKU. And there's a few SKUs within that category, but this is our acquisition category. Everything else we sell on the back end, on the front end, all of our top of funnel advertising, everything we're doing to try to get that new customer acquired needs to be to this category. We will sell everything else on the back end through email and SMS. What are some of the best practices brands need to think about in terms of like keeping their acquisition SKU catalog, so to speak, like limited and not let it get too out of hand?
Yeah, I think that some brands are overweight retention and some brands are overweight acquisition. I think more commonly we see brands overweight acquisition, where like they're always trying to like hit that next home run on Facebook or whatever to get new customers. I think that oftentimes the easier thing to do is find those retention SKUs. Some categories it's easier than others, but at the same time, if you are just in a category that is naturally low LTV, I do think that you may have to just go after more often acquisition SKUs, because you're basically acknowledging that acquisition-based funnels we're realizing a higher percentage of the value on that first order than you are over all time. They're inherently, in my opinion, riskier and have more opportunity for volatility. So in a way, you want to go after diversifying your bets by having multiple acquisition SKUs. In the event that you are in a category that lends itself to LTV, and it doesn't have to mean like 100% LTV growth. You can still have good LTV below that. You might be in a position where you can go and try to get meaningfully improve your LTV by having a more well thought out and diverse product catalog that can lend to that repurchase rate and repurchase AOV. Like a common issue we see is like really expensive first product and then super cheap second product. It's like, it's not going to move the needle that much. Like you want to make sure that like, if first order AOV is $200 and second order AOV is like $30, like even you're going to get such a small percentage of people who come back and buy that thing, it's not going to move that big of a lever. So you have to actually ideate like, what is that next product that someone can buy that has the right AOV? And it's sometimes easier said than done. Like sometimes categorically it just doesn't make sense, in which case I think you're almost better off going after acquisition SKUs. But largely, I think most brands don't spend enough time thinking about retention SKUs and building out a catalog where people can become super fans and come back and purchase again and again and again.
Interesting. Yeah. And I mean, look, from the finance standpoint, I think a big thing that brands need to think about when they're launching new SKUs as retention SKUs is really validating what the right order lot sizes are. Like what's the right size for placing those orders. And because what I've seen happen is like launch SKUs with the intent of them being retention SKUs and blowing up the product catalog, like pretty massive over the course of several years. And then starting to see overstocked inventory positions, their inventory days blended or going through the roof. You start diving into it and you're finding this subset of SKUs that are really driving the overstocked inventory position. And if you look at it, none of these are being bought in first orders. They're all returning customers. And then if you go look at the economics monthly of how much margin and AOV is being driven by new customers versus returning customers, the returning customer margin dollar and AOV economics are super low. And it starts making you feel like we have this like if we were to like separate that off to its own P&L and balance sheet, you have this upside down cash flow situation for these SKUs that are generating low AOV and ultimately low margin dollars every single month. But we have this huge inventory position. And so it's actually just draining the business's cash reserves. And so like the order sizing, when I think about the placing a risk adjusted bet around product launches, no matter what the intention of the product is, it's like, how can we commit to enough of an inventory size or purchase size that we can validate we want to validate, but not get stuck with excess inventory and start building inventory over time. Now, the thing is, there's a balancing act, right? Because like, we don't want to starve marketing, right? Of the ability to like have inventory to sell. But there's nothing worse than just tying up a ton of cash into a new product launch that just did not meet expectations, you know? And so I think sizing those initial orders, honestly, oftentimes, depending on the cycle of your seasonality and whatnot, like sizing those initial purchases for the first, you know, several inventory purchase cycles, I think is really, really important for reducing risk.
Yeah. And I think we've chatted about this too before, but generally, like, you're probably, in many cases, it's safer to sell out than you are to have too much. And luckily with return customers, it's sometimes a little bit more easy to accurately predict what sell-through may look like on some of these SKUs, especially if it's in a similar vertical to what you're already selling. So largely, I think the riskier ones are when you're going after those first-time customer-based acquisition products. Return customers, I largely agree. I think that the key thing is not to get overstocked to a crazy volume, and the benefit is you have a little bit more of reliability in the ability to move those units at least at a good margin. The question then becomes, at what volume? Totally.
Well, and I know we've talked about this in previous episodes, but there's other factors to consider in how risky the order size is. If you have strong LTV and repeat purchase, it might be less risky to order too big on your first order. If you have high seasonality and there's a seasonal obsolescence component to your product, like apparel, where like, hey, once winter's over, you're stuck with those until next winter, that can be riskier, right, than steady demand throughout the year. And then also, I mean, those are the two biggest ones that I see brands like not consider when they're sizing their purchases, right? I guess the other thing is like just seasonality of consumer demand in your product category. So like, for example, you know, at Guardian Bikes, if we way over ordered during the holidays, which we did a couple times in the years that we were scaling, you were definitely waiting until like April for sales to pick back up seasonally, because in the winter, people don't buy bikes after Christmas. And so, but for us, it was like, we would do a forecast, like, could we last 4 months? Because we knew sales would come back in April. And we're like, no, we can last 4 months. If we were worried that we might not be able to last 4 months, if we really missed our sales goals, then we might dial that order back. So it's about applying a little bit of logic to, you know, forecasting what could go wrong. What is your thought about, like, on the marketing side, like, and I'm sure this probably depends on product category as I'm about to say this, like thinking in my head, but like cadence, like speed, and frequency, what are some things to consider for best practices, or even like, you know, pitfalls, like traps you don't want to fall into by getting the cadence or frequency incorrect as you're trying to launch products over time?
Yeah. So I think that launching products are in some ways similar to launching ads, where hit rates are actually going to be impressively low. And I think that what one of my favorite things or one of my leading indicators of like an operator having success is ideally they've tried to launch products that have failed in the past before finding a winning product, because it helps you understand that you're not going to hit a home run every single new product. So what we'll sometimes see is an operator who first product they've ever tried to sell just crushes out of the gate. And that's awesome. It's really great. That'd be great if everyone could experience that, right? But the issue is there can then sometimes be like an overconfidence in the ability to churn out products. And maybe that leads to like just insane focus on like one bet and or an over concentration on that bet, i.e. like buying too much stuff, thinking it's definitely going to work. I'm generally more a fan of maintaining quality. So you have to have focus to actually build great product, but at the same time, understanding that, it is a little bit of a volume game too, similar to ad creative, where it's kind of threading that needle between volume and quality at the same time and making sure you're putting out as much great product as you can. And it depends on the category. Like for some clothing and apparel brands, launching new products is very easy, where you could like borderline do it weekly if you wanted to. For like a consumer electronics product, different story. So thinking through like, how do you maximize your bets? I think as you get bigger, each year your target should probably in many cases be, how do I do more than the year prior in terms of net new product launches? At a certain point, I think that starts to cap out when you get like really, really big. But even then, like I do think that oftentimes, similar to ad creative, most operators could probably get more out of launching more than they currently are. I think more shots on goal is directionally the way to go.
So it's interesting because like a couple of weeks ago, I did a training for all of our CFOs on risk adjusted bets and ways that a CFO, let's call it levers or strategies that we can help use to limit risk of different bets, right? And I just recorded this morning like a little mini episode for my other podcast about this, but I think it would be really helpful to share here as like kind of a conceptual framework. So like in the context of, we're obviously talking about the context of launching products, right? So like, how do you limit risk of a bet? One way to do it is limit the risk with the sizing of the bet, proper sizing of said bet. So if we have more uncertainty, that bet is riskier, right? And we should probably consider placing smaller bets. If there's more certainty about the outcome that's less risky, we can feel comfortable with bigger bets. So size of the bet is one way to limit risk. The next way that I was thinking about as you were talking is, how are we capitalizing or funding the bet, right? Like what's the capital structure of the debt? Is it debt, equity, or both? And so a framework to think about that, there's less certainty in the outcome. That means higher risk. So not just size the bet smaller, but let's use less debt, because debt is riskier to finance uncertain outcomes. If there's more certainty, that's a lower risk bet. Not only can we potentially place a bigger bet, like I mentioned earlier, but you might be able to use more debt, because debt is a good funding instrument when you have certainty about the outcome. A couple other things on the capital structure side, the maturity of the debt. So is the debt due soon? Is it short-term debt or is it longer-term debt? The longer term the debt is, the lower risk and the more you might be able to use that for riskier bets. The shorter term the debt, the sooner it's due, the higher the risk. And so you only want to use that on like the most certain bets or low risk bets that you're placing. Another thing is the interest rate structure. Is it fixed rate debt or is it variable rate debt? Variable rate debt is riskier and you want to use with lower risk bets, because the variable rate means the interest rate's changing monthly or quarterly and you don't have control over that. So the point that I'm making here is there's other ways to limit risk, but two that come to mind that are top of mind for me and my team are really thinking about sizing the bet properly relative to the risk and structuring the right debt or equity funding relative to the risk. And that's something that's 100% applicable with financing product launches. What is you in preparing? You brought up something called like this concept of an inside category versus a new category, or like a product that's inside your existing category versus like extending to a new category. Like I have a specific question for you about this. Like, do you see extending to a new category like working successfully? Is that a pretty low success rate. Like I know it feels inherently like more risky, but I've seen brands throw these shots out before in desperation. And I'm curious if you see branching out into a new category ever turn out to be successful, and if so, what some of the reasons are that there is success.
Yeah. So I'll take this back to like first time customer dominant brand versus the high LTV reliance brand. I think that like as ad costs have gone up, some people in certain categories with high first time customer rates and low LTV try to just shove LTV into a business model that just probably will not have it. And I think that when you have those situations, you're often better off, for better or for worse, going out and trying to basically find more acquisition products. And when you're trying to find more acquisition products, depending on your category, you might be able to find those products inside of your pre-existing category. But in some cases, you may have to go outside of category. And like category is a broad term. Like some things you can debate if it's in or out of category. But what I'll say is like meaningfully different. Like an example that is actually really hard to do, but I'll just use it for example. I am a menswear brand and I'm going to start selling women's clothing. Like same category, but it's sort of a different, it's like the defined category, I guess. So I think that like when you're thinking about inside category versus new category, if you're going to do new category, you should assume that it's going to be incredibly high risk. There should be a real business purpose behind it, basically saying like, I'm a low LTV brand or something like that, or I'm capping out on acquisition in this category. I'd rather make this investment versus say go sell in a different market and or in a different channel. Oftentimes all those things might be better first, but I have seen situations where like entering new categories can sometimes actually be a net positive. And maybe there is some crossover that can occur as well between the different product categories you sell.
Yeah, I'll give you an example that's like sort of new category, but I would say quite possibly more inside category. So Guardian Bikes, not that long ago, launched adult bikes. It's been a kids bike brand for the last 7 years or so. They expanded into adult bikes, but they had a very clear marketing narrative about the connection between the two. And it was like, get your entire family riding on a Guardian, right? Parents and kids. So we had been selling to parents to buy bikes for their kids, and all the marketing messaging was around like that these were kid specific bikes that are the safest on the block. And so there was definitely new marketing messaging that needed to be deployed, but they were able to, I think, very gracefully bolt it on to their existing product base and say, now your whole family can ride, get the whole family out and ride together, right? Much different than what you're talking about with going from like men's apparel to women's apparel. Furthermore, I will also say like, there's a gothic clothing brand that I work with, that for them to go from men's to women's or the other way around actually isn't as crazy, because the niche of like gothic apparel is such a focused niche that's not as crazy as like some other types of apparel, right? So point being, understand your customer and think about the customer journey and your value prop, and you might find the intersection of inside category versus new category is a little bit more blurred than you might think.
It's a gradient. So like and like wherever you go on the side, on either side, it's like high risk, low risk, but like sometimes high risk can have high reward too. But again, you have to understand that there's still high risk.
I'm dying to know the answer to this question. Have you ever seen a brand achieve meaningful 6 to 12 month LTV through new product launches? I've seen a lot of brands fail at this. Have you seen it, and how common is it? And I'm not trying to like, what I want to do, my attempt with having you answer this question is to give everyone some real data about like how hard or feasible this really is, because I think there's a lot of misconception in the marketplace about how feasible it is.
Yeah. So again, let me just paint a picture. So like one is like super expensive, durable, good, one-time purchase. Like it just lasts forever. And like good, like, I'm not sure what else you sell there. Like just first-time customer dominance. The other is like some CPG brand where like 12-month LTV goes up 2x, 3x, 4x, some extremely great like outcome. For the vast majority of brands, you live somewhere in the middle, right? It's like you're not in either of these extremes. If you live somewhere in the middle, can you actually find LTV improvements via net new products, or offers, etc.? The answer to that is yes, but is the growth like insane? Maybe not. Like maybe you can improve your 12-month LTV with great product strategy by like 20, 30, maybe 40%. But I think that's a really, really good outcome. Like more often than not, with a really good product strategy and product launching strategies, you might be able to improve your LTV on a pre-existing acquisition product. That's the key word here. It's like you're changing nothing about your ad account. Like you're still promoting the same fundamental offer on the front end, and you're just trying to get improvements on the back end. I'd say you're doing a great job if you're improving your 12-month LTV by like 20%. I think that's actually a really good outcome. So that's, and we can debate here all day how good that is. It depends where you're starting from, right? So it's like that's a key thing. The most common way we see LTV grow is by having an acquisition product that inherently lends itself to LTV. And if you already have LTV doubling in a year, adding 20% to that is actually pretty good if you can somehow add bolt-on products so people increase their subscription value by having additional complementary products, et cetera, et cetera. So it's normally based on how you're already doing. It's like a percentage improvement on top of that. So in short, it's really, really hard to improve your LTV. And it's not to say don't try to do it. Again, some of these improvements can be solid, but it's not like you're going to turn your business into like a subscription business overnight if the product doesn't naturally lend itself to it, right?
So I want to tell a little story from Guardian that I think helps illustrate thoughtful product launch strategy over time, right? By the way, not flawless, plenty of mistakes, right? But like thoughtful. Like we had, and I'm sure the business still does today, we had a multi-year product roadmap document that we kept up to date every single quarter. And that product roadmap had a strategy to it. It had thought to it. And it was a living document that we changed over time as we learned, but it was not random acts of product launches, right? So we started in kids bikes. We debated, we debated adult bikes since the beginning. There was very clear thought around why launching in kids bikes. And it was because if you think about our secret sauce, which is the brakes that prevent you from flipping over the handlebars, kids, in terms of the segments of the market, there's the biggest TAM of people that have problems with flipping over the handlebars in kids bikes. It's most common with kids, right? And it's also the biggest concern. We did find that it's also a concern on the other side of the age spectrum, like much older people, but not nearly as big of TAM, right? And so we started with kids bikes, and we specifically chose 2 sizes because we did a bunch of research on basically the TAM for 2-wheeled hybrid kids bikes, and found that like these 2 sizes where most of the TAM is. So we wanted to start there and really, gain product market fit and start to build a brand name. We did that for a couple years, but in our roadmap, and by the way, those sizes were like right in the middle of the various available sizes. We had planned to go 1 bigger and 1 smaller after that, right? Which we ended up doing. And then we found that there was 1 more smaller we could go to get kids as early as possible, which is a balance bike. So then we moved out to getting kids as early as possible. And what we did every time we went to, we went like 1 size up and 1 size down, was we had an estimate of how much TAM we opened up and how many bikes that family would buy from us from age 2 when they bought a balance bike until age 13 when they bought it, whatever. And so we had a theory each time about how we were increasing the LTV, or at least we were increasing and going deeper in the relationship with that customer, right? Eventually, we went 1 more size bigger on kind of the biggest kids bike. And then we've been talking about adult bikes for years, which they just recently launched. And so now you have 2-year-old to mom and dad, right? On that roadmap, several years down the line, there's also thoughts about electric bikes. We talked about scooters for a long time. We actually ended up abandoning scooters because it was an e-bike, an electric bike we determined is inside the category, is just like an extension of bikes. But a scooter we actually determined is quite different. And for us, we did a bunch of research how you make a scooter, right? And keep in mind, Guardian was planning on starting our own factory in the US, which exists today. You start looking at making a scooter, and it was like, there's a lot of similarities, but there's a lot of differences, right? And so the point, I'm just trying to walk everyone through this to give you a sense of like the thought that goes into a product roadmap. And we're thinking all along about this mission of like trying to get the whole family to ride bikes together, to get outside more, to exercise more, and to do so on a high quality, safer bike. And so the point that I want like everyone to take away from this is like, do the same exercise with your brand. Come up with a roadmap that's very customer centric, right? Not just launching products because it's cool to launch products or because you're seeing sales go down on some of your early day like hero products. Think about the customer journey. Think about we just kept thinking about like, how do we take the relationship from an average of 4 years to an average of 6, to an average of 8, to an average of 12, to an average, right? And so like, think about how to expand and go deeper with the customer relationship. And I think you do then have to figure out the unit economics and the go-to-market plan so that it's financially viable. But if what you're launching doesn't deepen the relationship with your customer in the first place, it's kind of like it doesn't matter what the financials are. It may not be sustainable over time. So anyways, I just wanted to tell that story.
That makes total sense. I'm going to flip the question back to you a little bit. Have you ever seen, like, you asked the question, like meaningful 6 to 12 month LTV improvements? I threw out like some broad ranges. Has your experience largely been the same where it's like, you can make some iteration, whether it be 5, 10, 15, 20% improvement, but like the probability of it being huge is relatively minimal?
Let's put it this way. I haven't seen a brand be able to go from being required to turn a first order profit to being able to lose money on a first order.
Yeah.
Through building. It doesn't change the game. You're playing one of two games. First order profitability game or a lower or negative first order profitability and make your profit on the LTV. I've never seen a brand be able to go from game 1 to game 2. It may make game 1 better, right? But not switch, not play a different game. You got to start a new business, I think, honestly, to to go from game 1 to game 2.
Yeah, I agree. It's too fundamentally like written into the business. This is a little bit outside of product launch strategies, but like the most common strategy we see for like meaningful LTV improvement is just, and like this goes back to like the last episode we chatted about, is like it goes down to like leverage opportunities. Is oftentimes the best way to increase subscribe and save revenue is essentially just to get the first order take rate of your subscription to go up. So how do you structure a funnel where you take like, let's say you had 5% of your first time customers subscribing and saving, and then going, how do you get that number to 40%? And if you can change that is like oftentimes much more high leverage on LTV than any sort of product launch strategy or email flow replenishment trying to get. So like there's a lot of ways to increase LTV other than new products. I think new product is a great one, but it's just about being realistic that like, hey, this is like an incremental gain. It's not like a huge swing for the fences gain.
Totally agree. All right, man. This was a good one. We went a little bit off script from where I was thinking we were going to go, but it was really, really good. Any final thoughts on your end?
I think the biggest thing is like I've just seen so many brands overorder inventory for new products, and it's such a bad position to be in a lot of cases. And I just often tell people just like play it a little bit safer, and then once you have the data, go big afterwards.
Dang, took mine. That's okay. Yeah, my final thoughts are just reiterating: you can limit downside risk by being thoughtful about sizing the bet properly and financing the bet properly. If you do those two things, you can have a miss, but live to fight another day. And that's the point. Get the learnings without betting the house on everything. So, all right, man. Episode 16. I think we did it. That's a wrap.
Yeah. Thanks, Jon.